ICICI Securities, we welcome you all to Q3 FY24 and 9 months FY24 results conference call of DOMS Industries Limited. We have with us senior management represented by Mr. Santosh Rasiklal Raveshya, Managing Director, and Mr. Rahul Shah, Chief Financial Officer. Now I hand over the call to the management for their initial comments on the 9 months and quarterly performance, and then we will open the floor for question and answer session. Thanks, and over to you, sir.
Thank you, Anirudh ji. Hope I'm audible.
Yes, sir. Please go ahead.
Thank you. Good evening, everyone. It is our pleasure to welcome all the participants to our first earnings conference call for the quarter 3 and 9 months period for the financial year 24. Joining me on this call is Rahul Shah, our CFO, and Marathon Capital, our investor relation advisor. I hope everyone had an opportunity to go through our investor deck and results release that we have uploaded on the exchange and our company's website. To begin with, I take this opportunity to thank all of you and the entire capital market fraternity, with a special mention to our shareholders for the overwhelming faith shown in our initial public offering. The listing marked a significant milestone in our journey, motivating us in achieving excellence ahead. Considering this is our first call post-listing, for the benefits of participants whom we are interacting for the first time, let me spend some time to provide an overview of the company. DOMS is one of the India's leading stationery and art product company. Our journey started in 1973 with the formation of RR Industries by our founders, my father, late Sri Rasikbhai Raveshya, and my uncle, late Sri Mansuklal Rajani, who over the years undertook the business of manufacturing and sale of pencils and crayons. Subsequently, in 2005, we launched the DOMS brand by incorporating this company, which was known as Right Fine Products Private Limited. In 2011, with an objective to streamline our operations and achieve integration, we merged all stationery business of group into this company. Further, in 2012, we entered into strategic partnership with Fila, a listed Italian multinational company engaged in supply of various art materials and stationery products with a global presence. As a company, we are focused on growing substantially and remain steadfast in our mission to consistently increase our market share in the interesting Indian market. Today, the company manufactures and sells well-designed quality stationery and art products, categorized primarily into 7 categories that includes scholastic stationery, scholastic art material, paper stationery, kits and combos, office supplies, hobby and craft, and fine art products. The company's products are primarily sold under the flagship brand DOMS, as well as through our other brands like C3, Amaris, and Fixifix. Our manufacturing facilities are located in Umargaon, Gujarat, and Bari Brahmana, Jammu. Our operations are spread over approximately 36 acres of land with over 1.25 million square feet. We are focused on achieving a greater degree of backward integration, which we believe enables us to improve efficiencies, ensure quality control, reduce dependency on third parties, and enhance profitability. At DOMS, we continue to focus on expanding our manufacturing capabilities so that we can quickly and effectively cater to the increased market demand of our products. Our ongoing expansion at our existing facility, coupled with our proposed 44-acre expansion, will provide us required resources to continue our growth momentum and enhance our market share. The success of our company would not have been possible without our multi-distribution channel network, which is spread domestically across 28 states and union territories of India, as well as in our 44 countries globally. The company's keen focus on research and development, product engineering, backward integrated-led manufacturing operations, driving a large and diverse product offering, has enabled DOMS to become the fastest growing stationery and art material product company in India in terms of revenue over the past few years. We believe that India continues to have a strong demand for stationery and art material segment, and DOMS is well positioned to capitalize on this growth opportunity, reinforcing a long-term vision of pursuing robust and profitable sales growth. We are sincerely thankful to our consumers, our channel partners, and our passionate team, which has helped us in delivering consistent growth. With this, I would like to hand over the call to our Chief Financial Officer, Mr. Rahul Shah, for the update on Q3 and 9-month financial year 2024 financials. Thank you very much.
Thank you, Santosh Bhai. Good evening, everyone. Coming to the details of our financial performance highlights for the quarter ended December 31st, 2023 and 9-month period ending the same. I would like to state our revenue from operations for Q3 FY24 grew by 22.3% year-on-year to about 3,716 million, and by 29.5% year-on-year 9-month ended 31st December to 11,334 million. This growth was backed by increase in capacities across our core product categories, as well as introduction of new product segments like writing instruments, as well as increase in the average selling prices of our products. The EBITDA for Q3 24 grew by 42.7% year-on-year to 694 million, and EBITDA margin expanded by 270 basis point year-on-year to an impressive 18.7%. EBITDA for 9-month ended December 31st, 23 grew by an impressive 57.8% year-on-year to 1,968 million, and EBITDA margin stood at 17.4%. This strong growth in EBITDA margin was primarily on account of lower raw material prices, as well as owing to the change in product mix and the benefit that the company received with the consolidation of Microwood, our subsidiary company. Profit after tax for Q3 FY24 grew by an impressive 43.4% year-on-year to 388 million rupees, and PAT margin stood at 10.4% as compared to 8.9% in Q3 FY23. PAT for 9-month FY24 grew by 69.1% year-on-year to 1,127 million Indian rupees, and PAT margin for this period increased to 9.9% as compared to 7.6% in 9-month FY23. The consistent growth in our performance reflects the power of our brand acceptance and is testimony of our effective implementation of our business strategy. On the operational front, we continue to focus on expanding our manufacturing capabilities to capitalize on the growth potential and gain market share. Towards this aim, we have spent approximately 280 million Indian rupees in capex in the third quarter of FY24, and have recently added about 100,000 square feet of manufacturing floor space in commercial production during this quarter. The manufacturing operations at this new plant was commercialized in a record period of 90 days from the completion of construction. Another 100,000 square feet of plant is under construction, which is likely to be operational during first quarter of FY25. This, coupled with our proposed 44 acres expansion, will provide us with the required resources to continue our growth momentum and enhance our market share. With this, I would request Anirudh to open the floor for question and answers. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Concall from BNP Paribas. Please go ahead.
Yeah, thanks. Congrats Santosh Bhai and Rahul Bhai for the listing and strong results. A few questions from my side. First is on the margins. EBITDA margins fairly strong at 17.4%, like more than 300 bps improvement. And if I go and look at the 4Q last year, like again margins were strong. It implies that you might end the year with more than 17.5% margins. So wanted to understand how sustainable is this, and are there any adjustments which you need to be aware of?
So, Kunal bhai, like mentioned during the call, the increase in margins are attributable to three key factors. One is a slight reduction in raw material prices, which was about 1.5%. There was a positive impact on account of integration of, consolidation of microboard, which is about 0.6%. And the rest change is due to the change in the product mix. There are certain products that we manufacture. We have a very vast portfolio. Certain products which are high on material consumption but low on direct expenses, and vice versa for some categories. So because of change in this product mix, we saw an improvement in the gross margins. At the same time, there was a slight increase in cost of manpower and power and fuel and such other expenses, which offset the gains in the operating margins. So as a result of this, we achieved this EBITDA number of 17 odd percent. Going forward, from a sustainable number, we continue to have a targeted EBITDA range for this year and between 16 to 17%. And going forward for the next year, between that sustainable number would be about 15 to 17%.
But this year, like when you already had 17.4,
yeah,
and 4Q at least looks like last year was strong. In that case, why are you guiding to a lower number, 16, 17?
Certain raw material prices, which were lower in the previous quarter have, again started to increase. The last quarter, certain polypropylene prices were, probably very low. This year, starting this year, we started seeing a reversal in that.
Understood. Thanks. Second one is on CAPEX. So, what number will you end up with in FY24? And, if you can talk about plans for FY25-26, and what will be the focus area of investments?
So, in the first 9 months of the year, our CAPEX has been about 117 crore rupees. In the last quarter itself, we did about 28 crores of CAPEX. In the current quarter, we project that the CAPEX would be upwards of 30 crores. We've started utilizing in this quarter some proceeds from the IPO for the proposed project. So given that we will end up this year close to about 150 crores of CAPEX. Going forward in FY25, FY26, our CAPEX would be between 200 to 225 crores in each of the 2 years.
Okay. Lastly, if you can talk about, while all the divisions seem to have done well, paper stationery seems a little weak. Is it because of decline in paper prices, or if you can talk about why that segment seems to be weak?
So, Kunal, in paper stationery, if you see in the previous years, the contribution of export sales to the overall paper business was higher. In the current year, due to some challenges in key markets like Europe, etc., exports have been a little lower, and that has impacted the paper business. But that has partially been offset by the increase in demand in the domestic market.
Understood. Okay. I have more questions, but I'll come back in the queue. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So just wanted to understand what is the volume and value growth, for first 9 months and the quarter, and along with that, specifically in the pencils business, if you can highlight what has been the volume and value growth.
So, Ankit bhai, at a company level, it is really very difficult for us to talk about volume growth, because we manufacture a lot of different products and each are sold in different sizes, units, packs. But if you talk specifically about wooden pencils, which is a key product segment for us, compared to the quarter ended in December 22 to quarter ended December 23, the increase in volume was about 16% in terms of volume. Then there are certain products, other key products like watercolor pens, mathematical boxes, where we've increased capacity there. Volume increased by about 61% and about 72%. So there have been significant volume growths where the company has added capacities. And on terms of value growth across most of our product segments, we've seen, ASPs increasing in the range of 3 to 5%.
And specifically for wooden pencils, what has been the ASP increase for the quarter and 9 months?
Wooden pencil, if we talk about our, again, we have two components there. One is wooden black lead pencils and wooden color lead pencils. Black lead is the significant portion, where the ASP increase has been about 3.5%.
So is it safe to assume that the wooden pencils is growing slower than the company average?
No, not really. Like I said, not really. If you look at the overall company level, our growth in scholastic stationery has been close to similar what has been our overall growth. Plus, also there's an interesting thing. For example, a lot of you'll see a significant growth in kits and combination packs. Again, these packs, pencil is a large constituent there. So those increase in capacities get diverted towards sales of such packs also.
Sure. And sir, could you just throw some light on, the channel-wise growth, what you have seen in the quarter? How has been the distribution expansion and, for 9 months and for the quarter, and where are you seeing higher growth?
So, like we've always maintained, our priority market has been the domestic market, and in domestic market also we've always focused on the general trade segment. So, general trade, segment continues to have the focus for us. This segment constitutes more than 75% of our total sales. Otherwise, from a channel perspective, channel mix, it has been pretty much in line.
So last year, FY23, general trade was 74%, and for the 9 months you are saying it's grown to 75% plus.
75%, yes.
So the decline is coming in which channel?
So if you see our numbers and the presentation, we highlighted that exports has been, which was earlier about 21%. Export has now slowed down due to certain, markets where, demand has been lower like Europe, and plus certain disruptions due to this logistical challenges from Red Sea disruption. So because of which exports have been smaller and now constitute about 18% of our sales. So that has been, absorbed by the domestic market and primarily in the general trade.
Sure, that's helpful. I'll come back in the queue for more questions. Thank you.
Thank you. The next question is on the line of Amit Jeswani from Stallion Asset. Please go ahead.
Hi, Ravesha ji. First time we are speaking. Good evening. My first question, sir, is that how large is the opportunity in front of us? And where do you see DOMS being in the next 3 to 5 years? First of all, congratulations on being a billion-dollar company by market cap. But what kind of profit pools do you aspire to generate for the next 3 to 5 years? Would you be continuing to growing at, so last decade we've grown at about 25-27%. Would it be right to say that kind of growth rate is sustainable for the next 3 to 5 years?
So, Rahul here. So just to take your question on the growth and the guidance, for, this year, FY24, we'll end with a growth rate of between 25 to 26%. And this is a similar sort of a growth we will target to achieve in the coming financial year as well. In terms of opportunity, we really believe that the opportunity in the Indian stationery and art material segment is significant. Not only is the market increasing because of certain factors like focus on, government initiatives on education and all, but also there's a lot of new demand coming in, with respect to, whenever we've launched certain types of new products which were not existent in the market. But the acceptance level of these products has also been very great. So we believe we'll be able to expand the market as well. So with new product developments, with our focus on R&D, product engineering, and getting the best product available at the best value, we think that the market potential is significant, and with our expertise and experience, we'll be at the forefront to leverage this benefit in the coming years.
And would you say that you will be reinvesting 100% of your operating cash flows in more capacity every year?
Very difficult to answer this at this point of time, but yes, we continue to see good opportunity in the existing product segments. There are a lot of new product lines that we would enter. In addition to organic growth, we are always on a lookout for attractive inorganic opportunities. So how things shape up, that will really constitute that whether we'll be doing 100% reinvestment. But yes, we do believe that the potential is huge, and we would want to be at the forefront with, getting maximum market share as much as possible.
So on our highest category, which is pencils, we are about 11% of the entire market, right?
No, entire market of... Sorry,
pencils. What would be our market share? Sorry.
Market share would be about 11 to 12% of the entire stationery market. Pencil is within that segment. If you talk about, then we are at about 29%.
Got it. And the stationery industry is growing at about 8%. Would that be the right benchmark? And we would be able to grow at 3 times faster than the industry?
So overall industry is growing at about 11 to 12%. Then there are certain categories within the industry which are demonstrating a little higher growth as well. For example, pencils, writing instruments, which are close to about 16% growth.
Got it. So got it. And our gross margins will stay at these levels broadly for going forward in the newer categories that we enter?
So, if you look at, gross margins across different products are different, and therefore we, as a company always look at EBITDA as the right, value to justify whether these products are doing well or no. So on an EBITDA perspective, EBITDA level, any new product that we intend to introduce, we work with that targeted EBITDA margin of 15%, and only then, proceed in terms of introducing that product in market.
Got it. Thank you so much. I'll come back in the queue.
Thank you. Reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Mehul Desai from JM Financial. Please go ahead.
Thank you, team, for taking my question, and congratulations for the great set of numbers. So my first question is on the distribution side. If you can give some flavor as to how has distribution increased versus what you ended on FY23, and how do you look at it going forward over next 2 to 3 years in terms of your outlet reach? That's the first question. Second question is on the regional mix. If you can give some flavor, how much of your revenues are coming from North and West market, and how much is coming from South and East, and what is the strategy to drive growth more in South? My understanding is that we are under-leveraged or under-indexed in South versus our North and West markets. So if you could address these 2 questions.
Yes, Mehul bhai, sure. So Mehul bhai, to answer your first question, in terms of retail footprint, in Q2 we had about 120,000 retail outlets which were touching directly, which was serviced through our sales team. In the third quarter, this number increased by about 2,500 retail touch points. In terms of distribution reach, the increase was close to about 200 distributors during the quarter. In terms of regional mix, if you see historically also we were present in accord, sales from each region justified the population of that region, and even currently it is similarly justifying the presence where the population is highest. North, it constitutes to the highest sales, followed by west, and then south and east. So it's a very balanced mix in proportion to the population of that particular region.
Sure. And any guidance on where this distribution can go over next 2 to 3 years in terms of the outlet which you mentioned?
So it will be a gradual increase. Our strategy from earlier time has been that wherever we reach, the new retail outlet we open, we maximize the throughput from that particular retail outlet. And therefore, wherever we are entering a shop, we would want to justify the requirements of that particular retail outlet and only then expand. So it will be a gradual increase over a period of time. And, we would not want to get into that numbers of increasing it at a very fast pace, but do justification to each store where we are present.
Okay. And any flavor that you would like to give on what kind of newer categories that you are looking? I think we have taken a small stake in a toy company too. So if you could mention what's the outlook in in these categories, what are the plans, or what are the new categories that we like where we think that we can expand maybe in next 2 to 3 years apart from the current stationery products that we have?
So, like you were aware, in this current financial year, we entered the conventional pen segment. That as a product segment is something which is seeing a very good and positive response from the market. After the launch of this product, since about 7-8 months, we have been able to, meet the requirements only of few states in India. We've not been able to sell this at a pan-India level as well. So this product segment is seeing a lot of demand and, interest from our consumers. Similarly, scholastic adhesives, we are in the process of launching a very wide range of scholastic adhesives and also expanding our product portfolio in the fine art range. So these are the key product segments or categories where there would be, continued focus. Nevertheless, in our existing product segments, categories also, we continue to keep coming out with new SKUs which are more relevant with what our consumers are experiencing, and those product launches keep happening on a regular basis.
Sure. Great. Thank you. That's all from me.
Thanks, everybody.
Thank you. The next question is from the line of Chinmay Neema from Present Capital. Please go ahead.
Good evening, sir. Thank you for taking my question. Just trying to understand the historical performance of the company. So if I look at the last 2-3 years, the top line has almost doubled from FY22 to FY23. So could you help us understand what happened during that period? What was the reason for that? Secondly, the working capital has also really improved in the last 2-3 years. So what happened there, and what should be the normalized level that we should look at?
Sure, Chinmay. So, firstly, just to, FY21, FY22, these were 2 years which were actually impacted because of COVID. As you would be aware, most of these periods, educational institutes remained shut, and hence the demand for stationery products decreased significantly. So it's more of a base year sort of a effect rather than, growing 100%. The base figure was wrong. In FY23, with the educational institutions opening up, we continue to see good demand for our products. Plus, during the COVID years, the company had, continued to do capital expenditure to enhance our capacities. So in FY23, due to increase in capacity, a little bit of effect of the, pent-up demand, we were able to increase our sales by almost 100. Like I said, now this is more of a normalized period. That's why we believe from a guidance perspective, we will be doing about 25% growth in our sales. And so that would be the same. And sorry, I missed your second question. If you could just working capital. Yeah. So in terms of working capital, the change that you see has been primarily on account of our entire domestic general trade segment, where we used to extend a little bit of credit, was moved to a cash and carry advance sort of a model, because of which our debtors days went down significantly. Also in terms of inventories, with the company's operations being more increasing, there was a better inventory utilization that we could do. As a result of these factors, predominantly working capital reduced. Our current working capital is also close to that, about 37 to 38 days. And going forward, our range would be about 40 to 45 days, considering that there are certain products where, we by choice keep a higher working capital, higher inventory levels, and that too only in raw materials, because there are dependency on certain natural resources. So when the sales of these products increase because of capacity addition, then the working capital days go up. In terms of debtor days, we are still at that average of 12 to 13 days only.
Got it, sir. That's really helpful. Just lastly, if you could comment on, as a company, how do we differentiate ourselves from our peers? Just trying to understand whether the future growth is supposed to come from taking the market share from other companies, or, is there enough market for everyone to grow?
Firstly, we never try to compare ourselves or place ourselves with our peers. We believe in, being ourselves. Whenever we would want to launch a product or launch a category, we always believe that we look at what our consumer are, who are consumer, and we understand our consumer much better than anybody else could do. So therefore, we know basically what is the requirements of our consumers, and based on that, we design products, develop products, and this everything happens in-house, right from designing to development and to, conceptualizing, manufacturing. We have a completely backward integrated operation. So as a result of this, we become very efficient, and this is seen in the pricing of our products also. So we are able to give a far more superior product at a very good value to our consumers, which brings them back to DOMS. So that is one of our key success factors, which is a mix of, like I said, our manufacturing capabilities, our design capabilities, our understanding of our consumers, and this is what we want to continue doing for across all the products that we are into and we intend to enter into.
Got it, sir. That's really helpful. Thank you.
Thank you. The next question is on the line of Dinesh Joshi from Prabhudas Lilladher Private Limited. Please go ahead.
Thanks for the opportunity. Sir, I want to understand our CAPEX plan a bit better, because if I look at our RHP, we had mentioned that we'll spend about 450 crores, and the plant will be operational by December 25. But if I look at our PPT, we have also mentioned that we have commenced a production at about 1 lakh square feet, which is within our existing infra, and additional 1 lakh square feet will become operational very soon. So what is the CAPEX that is earmarked for this 2 lakh worth of area which is due for expansion? And which all categories will we be spending this amount into?
So, just to clarify, the RHP, what the plan was given was for the proposed facility and expansion in the newly acquired 44 acres of land. Out of the total amount which was given of about 450 plus crores, the company had already acquired the land for almost 75 crores. So balance was about 380 crores of investment, of which 280 crores was raised in the IPO. This project is, we just recently received the final approval which was required before commencement of construction. This was in terms of getting the town planning approval. So we are now soon expected to start construction on this newly acquired land, and the capex towards that building and construction is something which we will start seeing from the coming quarters. In terms of what we built in-house in our existing infrastructure, we had already acquired the land, and on these lands there was possibility of increasing, constructing 2 more buildings, which we did. One building of 100,000 square feet became operational, and we started getting revenues from this from the month of October. This building is purely for our writing instrument segment, where we've started with commercial production of the conventional ballpoint pens, and also increased slightly our capacity in markers and in brush pens. There is a building adjacent which is currently under construction. Construction is almost over. We will soon start setting up the plant and machinery at this building, and expect to get commercial production from Q1 2025. If you see, even with the first building, we were able to set up commercial production in a record time of 90 days from the time we got the possession of the building when construction was complete. Here also, we expect the same sort of a time frame. And again, this building, considering the demand for the pens that we've launched, is much higher than what we anticipated earlier. So this building also we would want to focus in terms of writing instrument to enhance our capacities in pens and the ballpoint pen segment.
How much are we spending incrementally for these 2 adjacent buildings which you just mentioned?
So in terms of construction, so like I said, so in terms of going forward.
So sir, this
this year in the 9 months, like I mentioned, we've spent about
170. No, sir, I get that. My question was, for this additional 2 lakh square feet which you have just mentioned, how much are we spending specifically for that?
In terms of construction cost?
Yes.
One building is already ready and the construction completed, and for the second building, we'll be spending a total, additional expense would be of about 17 odd crore rupees.
Got that. And sir, last question is with respect to our working capital. You mentioned in your answer to previous participant's question that we have moved to cash and carry, and hence our receivable days have come off quite a bit. So just wanted to understand in terms of positioning, if we are on this cash and carry model, so to say, so do we offer a higher dealer distribution margin as compared to peers, or what is the point on which we are competing to get a higher revenue share? Because I think credit period and margins are the 2 things which essentially anyone would compete on.
So honestly, right now we are seeing a very significant pull from the market, across our, across domestically or also in exports. There's a very strong pull for the DOMS brand, because of which, and what is happening with the retailers also is the DOMS products which they get, they are witnessing a fast turnaround. And as a result of this, the demand itself is very high. So in terms of margins, our margins from the channel would be in line with what the entire industry offers. The pure reason that we've been able to shift the entire trade to a cash and carry sort of a model has been because of the strong demand and pull for the brand and our products.
Got that. And so what is the industry-wide distribution margin, or for that matter, your distribution margin, the entire channel, if you can call it out?
Our margin, in terms of there are certain products, different products have different margins at the retail level, but at the stockist level, our margins are about 5.5%, and at the distributor level, it is 9%, and then for the retail level, it's different across different products.
Got that. Thank you so much, sir. Thank you.
Thank you.
Rahul bhai, Aniruddha here. Some questions from my side as well. In terms of branding initiatives, so while the growth has been very, very strong, and as of now we are not investing in ad spend, but now new capacities are coming on stream. So will there be any change in the plan in terms of the branding initiatives?
So, honestly, as you know, historically also and now also, our marketing and advertising spends continue to be in the range of 0.4 to 0.5%. Till now, we've not seen the requirement for investing more in this with the new capacities of pens. Also, like I said, today we are being able to sell only to 4 or 5 states of the country. With the capacity. So the demand is already there, but if required in future, if we see, then the capability is there to increase the spend, but as of now, we don't see such a requirement. And whenever needed, like I said, our financial profile allows us to, invest in this segment.
Yeah, sure, sir. Understood. Secondly, in terms of the pen rollout, the 5 rupee pen, I guess it was initially in Gujarat market. And now, how do you see the progress in terms of the rollout on a pan-India basis? And any growth targets that you have in the mind that you can share on the pen business?
So, Aniruddha, right now, initial rollout was definitely from Gujarat and then MP, and till now we started selling in about 5 states of India. Today we have one building is already ready and doing commercial production of pens since October. Another building will soon be ready. There, once those capacities come in, that is when we'll expand to other states. But here also, like when we spoke about our retail footprint, here also the idea is same. Wherever we enter, whatever state we enter, we want to take a position of significance of leadership, justify that position, and only then move to new territories. So that's the same strategy we'll follow. Like I said, the initial response has been significant. We are happy with it, and we believe this to be a key segment for the company soon.
Sure, understood. In terms of the revenue salience of the premium products, for example, in case of premium pencils, the pricing of, let's say, 8 rupees and above, let's say, if we consider as premium and luxury. So, if you can indicate the company's revenue share from the premium products and how it has moved over a period of time. Also, in case of these relatively premium products, what will be the company's market share versus the other brands into the market?
So, honestly, at the company level, we do not want to track it at such a micro sort of a level. See, today in terms of when we talk about pencils, the 6 rupee MRP pencil continues to be the largest selling, product segment for us. New capacities also coming in. It's well distributed across those segments. But specifically, how much market share or how much sales coming from that specific segment, that's something which we don't, wouldn't want to track and differentiate into.
Okay, sure, sir. Just 2 more questions from my side. One, in terms of the toys business, so any update on that progress? How many new products that have been in a way rolled out or are in the pipeline? And in terms of distribution, where are we as far as the toys distribution is concerned? I agree it's a very recent acquisition and still a lot of work needs to be done. But if you can share any pipeline, let's say for FY25 or so.
So, Anirudh, like we initially discussed, toys, the acquisition that we did was to understand this market, understand the product, and to see how these products can complement with our existing distribution network. So towards this, we a lot of product redesigning is happening. A lot of products are being packed in such a way that they become attractive for retailers to have in their stationery shops. We've already started selling Clapjoy products in our existing distributor network, especially in the north market. The initial feedback has been positive, and that is how we are thinking of expanding this segment, rolling it out on a pan-India basis. So going forward, though very small now, but we are optimistic that in a few years' time, this segment would be attractive and decent in terms of size. And, once it becomes larger, I think we will start discussing more in terms of numbers with respect to this particular segment.
Sure, sir. Understood. And very last question from my side. Now the market shares of the key products of the company are not very easily available in public domain. So if you can indicate the likely market share gains in this quarter or let's say in 9 months, what it will be? Any further color on that, means in terms of which are the products would have gained market share or which are the regions where you would have gained the market share? Even if you don't share the numbers, it's fine. Just a qualitative feedback is also very appreciable. Yeah, that's it from my side. Thanks.
Honestly, Anirudh, like you said, it's very difficult to track the size of this market. Therefore, we would also not have a lot of information in terms of the size of the market and which segments have grown. In terms of DOMS, what growth we've achieved and in which particular segment, that we've already disclosed in our presentation. So I think nothing additional to add in terms of market size, unfortunately, because it's not something which is readily available.
Understood. And any guidance that you would like to roll out for FY25 in terms of revenues or margins as such?
So as mentioned earlier, in terms of revenue for FY25, we would, want to guide close to that 20 to 25% sort of a range with an EBITDA margin between 15 to 17%. So we always believe good to be a little conservative and deliver something better which will create a wow factor for everyone. So we'd want to follow that as well.
That's really actually a great guidance. Yeah. Thank you. Thanks from my side.
Thank you. The next question is on the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks. I was looking at segments. It looks like art material and office stationery seem to have done well with upwards of 35-40% growth. So what's happening here, and is pen contributing to the office stationery sales?
Yes, Kunal bhai. So pens is a part of the office supply segment. So, like mentioned, we added capacities in pens. Therefore, you will see, growth in that segment. In terms of art material also, there has been capacity additions in our crayon segment, in our watercolor pen segment. So these capacity additions coupled with a slight increase in the ASPs has led to that growth.
Okay. So wherever you are adding capacity, you are immediately seeing growth so far. How big is pen right now? I mean, say if you look at 3Q FY24, what will be the contribution, and how big do you see it happening in FY25, considering that you have visibility on capex, and if you are able to sell what you are producing, in that case, how big can pen become in FY25 versus FY24?
So, I can talk about the current quarter. Like I said, there's pen is something new, so we want to take it step by step as and when we launch it. But in the current quarter, if I have to say, we did about 16.5 crores of revenues from the pen segment.
Okay. And how large a capacity are you deploying on the pen side? Are you looking to double, triple? What kind of capacity increase are you planning for pen?
So in the current building that we've already started, our capacity is 1 million. The new building that we will now, come into commercial production in the next quarter, in first quarter of FY25, that would be additional 1 million. And then would be the new capacity that would come from the 44-acre plant, which would be about 4 million. So double of what we will have in the existing infrastructure. So eventually we'll target to have capacity in pens of total of about 6 million.
Okay. So right now it's 1 million and you're doing about 17 crore of sales, and it will be 6 million. So assuming that say it's a linear increase, in that case you're looking at a much larger number.
Even what would happen, Kunal bhai, is not the entire capacity was started from day one. It was enhancement over a period of time. So I think once we have a couple of quarters go by in terms of full-fledged production, then we'll be able to guide on this number a little better.
Understood. Okay. And you mentioned that microwood contributed to the improvement in margin in 9 months. What was the revenue contribution, or say if I want to look at just the organic revenue growth, how would that be compared to what you reported?
So basically, if microwood, our subsidiary basically is into manufacturing of tin box and paper packaging and boards. So basically, most of these products are sold to DOMS and our other subsidiary Pioneer. So about 98% of the sales of microwood goes to DOMS and Pioneer only. So there's no material increase in sales because of the acquisition of microwood, but it is purely because of the elimination of margins on consolidation that you see the benefit at the operating level.
Understood. So there is a margin impact, but not really a
not a revenue impact, it's a margin impact.
Understood. And lastly, if I look at most mass consumption categories, we've seen a slowdown in the last few quarters. Are you seeing any slowdown at all? I mean, I understand that, say, through market share gains, you might be growing fast, but otherwise, what's your view on what's happening in rural markets as well as mass consumption categories?
It's absolutely in line with what it was earlier. What we were doing earlier, we continue to do so. We see the demand be healthy and strong for our products across markets, rural, urban, A+ cities, everything is pretty much similar. It's healthy. We have not seen any sort of slowdown, as to say.
Understood. And lastly, if you can make some comments on international as well as exports potential in FY25, how are you looking at it, especially with the additional capacity which is coming in? Would you prioritize the local market, or do you have some big plans for international markets in the near term?
So, since the time we launched DOMS brand, our focus has been domestic, and that we'll continue to do so. We believe that the opportunity in the domestic market itself is significant, and with the right sort of product and offering, we will be able to capitalize on this significantly. So that focus will continue to remain in the domestic market. Export also has a lot of promise, but we'll be very conscious in terms of how much we want to do. It will not be at the cost of the domestic market.
But now that you have the capital, why not accelerate the investment and capture the international markets also at the earliest, or do you think that?
Like I said during the introduction part, also, today at the speed at which we are commercializing operations, we commercialized our pen plant within 90 days from the day we got possession of this plant after the construction being over, which would be probably the fastest in the industry. So definitely, like y'all, we are also very excited about the potential and would want to do this as soon as possible. But then there are certain things which take their time. You could not accelerate it significantly. And we don't want to make any mistake in this entire journey.
Understood. And what's the net cash as of 9 months FY24?
Our net cash as on 9 months, which has an impact of the IPO proceeds. So, there's about net cash of about 430 crores with a net debt of about 156 crores. So if you net it off, that's the cash position.
Understood. The cash of 430 and debt of 156. Okay, so net number.
From the IPO which came in.
Understood. Okay. That's it from me. Thank you.
Thanks.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to the management for the closing comments.
Thank you. Thank you, Anirudhji, ISEC team, and thank you, leaders. I would like to once again thank all of you for joining us on this call today. We hope we have been able to answer your queries. Please feel free to reach out to our IR team for any